Good morning and welcome to our webinar on blended finance. I'm very pleased to welcome you today to present the findings of the report that we have published yesterday. I'll wait one more minute to give the opportunity to the people joining us to get in the call, but please stay online. We'll be starting in a minute. Good morning, everyone. Please stay online a few more seconds, and we'll be starting any moment, giving a chance to everyone to join the webinar. So good morning. We're going to start now. Very happy to welcome everyone to this webinar on blended finance. We have published yesterday. So first of all, my name is Laura Semius. I'm the director of the NAB, the Netherlands Advisory Board on Impact Investing. We are the organization that published this report on blended finance with the help of our working group. I'll tell you a little bit more later. I have with me today three guests that will also be presenting case studies and joining me for a panel conversation. We have Julia Tordes from Better Society Capital, Dolores van Rooij from InvestNL, and Wouter Soetaert from Triodos Investment Management. We'll come back a little bit later on the part that they will be presenting. So what we would like to do today is give you a few highlights about the report. Then we will present three case studies extracted from this blended finance report that we have published yesterday. Dolores will be presenting a case study from the Netherlands, Julia from the UK, and Wouter from emerging markets. And we hope by featuring these three case studies to give you a bit of a diverse view on what type of problems blended finance structures can solve. Then we would like to keep some time for a Q&A moment. On purpose, we've proposed this session to last an hour and 15 minutes instead of limiting it to an hour. This is to give you time to interact with our panelists or with the team if you have questions. So do not hesitate during the webinar to put your questions in the chat or in the Q&A. And then we hope to wrap up around 12:15. Without further ado, let me give you a very, very quick introduction. So the NAB, for those who don't know us, we're a foundation in the Netherlands, independent, and we have the ambition to be the prime platform for impact investing. And of course, to try to be a leading center of expertise and innovation. And actually, that's because of that ambition on the expertise side that we decided to form a working group with our members already a year and a half ago on blended finance. But let me tell you a little bit more about us. We are a part of the GSG Impact National Partners Network. Present in 50 countries, actually 50-50 split between developed and developing markets, and representing together more than 2,000 impact practitioners in each of their ecosystem. In the Netherlands, these are the organizations that support the NAB and the building of our knowledge and of the ecosystem. So as you can see, many organizations from very different profiles, from foundations to pension fund to insurance company to public investors, a very diverse group of impact-focused organizations. So coming on the report, why did we start this report? In the Netherlands, there's a lot of talk about blended finance. And obviously, like buzzwords, it's sometimes a bit of a container term. So everybody's talking about it, but we're not really sure what it means exactly. And for many organizations, it can be seen as a solution to tackling an impact societal problem with the mobilization of private sector money. But unfortunately, because a lot of organizations didn't know exactly what blended finance is, they feel that they can be limited. And our role at the NAB is also to try to bring structure to the overflowing information that we can get in the market. So our ambition with the working group was to try to understand better what kind of structures exist and how can they support the further development of the ecosystem in the Netherlands and elsewhere. So we had many organizations that joined our working group and supported the building of this report. I really want to take this opportunity to thank them for their time and contributions. We would not be able to provide this information without them. Thank you all of you for providing the case studies that allowed us to do the work. A few words about the methodology that we used for the report. So we based our research on the cases that were provided by the working group member. Next to that, we try to enrich this information by using additional information retrieved from publicly available content. Think about websites or annual reports. We also wanted to present a balanced picture. So when we looked for case studies, we tried not only to focus on Dutch examples, but also enlarge it to our European neighbors and also to emerging markets. And actually, interestingly, emerging markets have been the largest provider of case studies on blended finance. Probably so because they have some of the biggest challenges also to be solved with finance. But when we collected these cases, we really tried to balance the origin of the case studies to give an as complete as possible picture. That being said, the report does not ambition to be exhaustive. It is an illustration and we try to collect as many cases as possible, but it does not have the pretension to be completely exhaustive. So bear with us on this aspect. Don't expect to have all the possible blended finance strategies or cases that exist. There are many, many, many more. So based on these case studies, we try to recognize patterns. So we identified 5 typical blueprints of blended finance structure, and we thought having these blueprints is really what could help potential interested parties to recognize, okay, this is where I could bring a contribution on the financial or on the impact side, and recognize the respective roles that each stakeholder could be taking. We also looked at these case studies and tried to draw a couple of lessons. So these will be presented as well. And then to make sure that we didn't write anything silly, we asked again the working group members, the case study owners to review the report And we were also very lucky to have the review of two persons that are really good in this respect. Emmanuel Javois from CGAP, part of the World Bank group, gave us some contributions, and I really want to personally thank her for that. Emmanuel is a blended finance specialist since many, many years. And of course, our NAB board member, Jaap Rijking from FMO, did a very thorough editorial review of the document, and I would really like to thank him as well for dedicating his time and energy to the report. So the blueprints. Let's dive into the topic immediately. We have identified 5 kind of structures. I will immediately jump on them. The first one, we wanted to make it clear that it's phased capital development. And actually, it's blended finance, but it's also what any project that is being financed normally used at different time periods of financing, be it for startup, for a difficult topic that needs to grow, for infrastructure projects. At some point, you might start with friends, families, and fools funding, and then over time, as your organization will mature, you will use more blended or commercial funding. And we wanted to mention that not because it's a blended finance structure in itself, but because it is over time blending different type of financing. So blended finance sounds like a very buzzword right now, but actually it has always been used in any kind of finance over time. The typical blended finance that you can encounter is also the mix of different type of risk positioning. This also already exists in what we call more mainstream finance. If you, for example, have subordinated debt next to senior debt, this is a form of blending as well. And if you push it further, if you have an impact-focused organization that is providing what's called a first loss, taking a higher risk or concessional capital, next to senior, more commercial funding, this is also a form of blending. With optionally, of course, you have all the gray area of more mezzanine junior capital that can come in between. And that can happen at investor level, so who is putting money, for example, in a fund, but it can also happen at investee level. So who is, which type of organization the fund is financing. So the risk blending is one of the key structures. There's a second one. So just for your information, these charts have been extracted from the report. You can find them with detailed explanations. So I'm not going to spend too much time on that, but just very briefly. So the return enhancement is basically next to the risk blending. You can also use catalytic capital either to increase the return for the more commercial capital provider so that they can reach their minimum target of risk-adjusted returns, or you can use it to decrease the cost of funding for the investee. So it can go both ways. And I'm just going to leave it now. There are many other possibilities, but you will find them in the report. Blended finance can also happen with a mix of not only different types of investment, but also grant alongside investment. So typically, technical assistance or capacity building given to an investee, be it a social enterprise or an MFI in a developing economy. So the mix of these investment fund with some grant funding to reinforce the capacity of the investee organization is also something that is a form of blended finance. And we've also put, you can of course combine it with the investment blending, as you can see in the middle part of this graphic. But it doesn't have to, it can also be completely mainstream commercial funding and technical assistance next to it. And then the fifth and last structure is actually a compilation of all the rest. So blended finance is all about mixing and matching based on what your needs are. So you can have all the structures, only part of the structures together. Yeah, so let's leave it there. To summarize, so the key characteristics that we've sort of isolated for blended finance structures. First one is basically matching the risk to mobilize. So the idea of blended finance is really to bring together different stakeholders to mobilize private investment to realize more impact. And that includes matching different risk levels. We can also match different return levels, also to attract and mobilize more private capital. The third one is that you can pair the financial tools with some technical assistance, the idea being to further support your investee, which can not only help the investee himself, but also de-risk your investment further. And finally, the fourth characteristic of blended finance structure is really the alignment of incentives and governance. Because in a blended finance structure, you work for that common goal, which is the impact. And it is with that intention that you bring these structures together. So let me move on. Yeah, the lessons learned. Maybe even more important than the characteristics. Blended finance requires contextual structuring. So it's very difficult to standardize. Investors have different profiles. Various sectors have their own dynamics. Of course, it's very dependent on the local context. And so our inventory tried to identify some replicable blueprints, but their applicability and effectiveness really depends on how well they respond to the investor goals, the risk perceptions, or the contextual constraints. Second point, investor negotiation and perceptions will shape the structures. Blended finance structuring is inherently a negotiation process, either between the fund managers and the investors or catalytic capital providers. It's not only driven by financial logic, but by each party's interest or challenges. And then the last one is that it's very important for catalytic capital to align with the impact objectives and for the blended finance structures to be accountable. So you can't ask for return enhancement, for example, or de-risking if it's not to achieve a certain path to your impact objectives. Whether these impact objectives are environmental, social, developmental, doesn't matter. Transparent reporting is essential for accountability, for reinforcing trust, for the catalytic role itself of the investment. And therefore, I think impact investing, with its existing reporting and transparent frameworks, is ideally placed to support blended finance structures. So, without further ado, I would like we've already introduced our panelists, but maybe, so let's give the word to our first panelist, Dolores de Roy from InvestNL. And Dolores, you senior business development manager, and at InvestNL, you're going to present us 2 mandates of InvestNL.
Yes.
The word is yours.
Hi, everyone. Thank you. Yeah, I will shortly present a bit on InvestNL. For those who do not know InvestNL, InvestNL is the largest impact investor within the Netherlands. Just like the NAB Impact Investing or the NAP, we are currently have been in existence for 5 years, 5.5 to be exact. And we've been established to decrease the financing gap that exists for scale-up companies within the Netherlands, specifically on a few themes. So we are focused on 5 main themes, one of them being energy transition, and the other ones being life science and health, deep tech, agri-food, and the circular economy. We have 2 main departments. So I am currently working within our business development department, where we focus on market research and product development. And on the other side, we have our investment mandate, which can invest in a market conform manner in these startup and scale up companies that are innovative and have a sustainable focus. And in the spring of 2023, we have created this, we call it a covenant, a collaboration agreement with the Ministry of Economic Affairs that focuses on blended finance specifically. So if you want to read a bit more, there's lots of it online. But the initial reason to set this up is that although blended finance is quite broad, as just described, the ministry was looking into manners to invest in these startup and scale-up companies that could have a very positive impact within the Netherlands. But there were state aid restrictions. So either they were maxed out on their subsidies, or they actually thought this could also be having a positive return for the government as well. And we see potential to basically also, with the additional risk that we take, find a return in this specific investment or financing. And therefore, the PPPSBV, which is a abbreviation for the publiek-private productstructurering. So it's a Dutch, but it's almost the same in English. It's basically private-public product structuring that focuses on these blended finance products that could be creating an investment for the government as well. So we are focusing there on quasi-equity and subordinated loans. And recently, actually yesterday, we have closed our first official investment within Avantium, which you might or might not know. It's a circular economy based scale-up company that focuses on circular plastics. And we are working on a lot of different ones in the previous years and are still working on a few that will be coming live likely in the next this year and also next year. But while we are working on that mandate, which is something that allows the Ministry of Economic Affairs to put their money in action in a different blended finance way, we are now also working on a new blended finance mandate. So this mandate will hopefully become live in the first quarter of 2026, so the next year, We are still hoping to get our state aid approval from the European Commission within this year, or otherwise in the beginning of next year, so we can roll the mandate out. And this mandate consists of 250 million euros that could be invested again with quasi-equity and subordinated loans, also in the investment themes of InvestNL, and with the focus a bit more on energy transition and circular economy and on deep tech. And the reason why it has been set up is because apart from a actual startup scale-up review by the European Commission, there's been a research that has been done, governmental research that has been done in the last year, that really discovered there's quite some financing gaps in the scale-up sector within the Netherlands, and especially for those with financing needs of between 10 and 100 million euro. And that's why this mandate has been created. So it can look at those scale-up investments, take on this subordinated or additional risk that can basically lure in private investors to invest in these impactful startup and scale-ups, and potentially also bigger corporate first-of-a-kind plans or other impactful projects or companies. So that's in short, hopefully short enough, the two mandates that we have that are focused on blended finance. We've done a few research papers as well, so have a look on our website. And if you have any questions after this panel discussion, please feel free to reach out.
Thank you very much, Dolores. So that's a very interesting example of different type of funding used at investee level and to mobilize more private sector financing for an underserved segment that is the scale-ups in the Netherlands. Yes. Thank you very much for this. So we'll have the opportunity to ask you some questions later on, and the audience as well. If you have any questions for Dolores, please put them in the chat. But now I would like to give the word to Julia Todres, who is investment manager at Better Society Capital. Let me check if I can change the slide. Yes, Julia, you will have to tell me when you would like me to move the slides.
Will do. I'll try not to give everyone too many pandemic flashbacks. Morning, everyone. Yeah, it's really great to be here. As Zoe said, I'm Julia Todres. I'm an investment manager at BSC. And I thought I'd start just by giving you a quick overview of who we are and what we do. So BSC is the UK's leading social impact investor, and really our mission is to grow the amount of money invested in tackling social issues and reducing inequalities across the UK. And we do this in two main ways. So first of all, we invest our own capital, but we also help build the market for sort of broader social investment in the UK. And we act as a social investment wholesaler. So effectively, we're a fund of funds investing via funds and intermediaries rather than doing so directly, as Dolores was describing. Our approach is really designed to catalyze co-investment, bringing in additional capital from investors like government, foundations, institutional investors like sort of banks and pension schemes. And I'll just take a moment to tell you a bit about how we were set up, because it's quite a unique story, and I think it's highlighted in the report as well. So BSC was created in 2012 with a mix of public and private funds, as you can see in that sort of first blue box on the screen. We were capitalised with 425 million from dormant bank accounts in the UK, so money that hadn't been accessed by people from their bank accounts. And this is known as the Dormant Assets Scheme, and 200 million from 4 of the high street banks, so Lloyds, NatWest, Barclays and HSBC. And I should say now that if anyone sort of comes looking for those bank accounts, they do get their money back. But while that money is sitting unused in the system, the UK government made it available for social investment and some other good causes in this way. And our goal from the outset was really to scale the social investment market whilst also being a self-sustaining organisation by investing our own balance sheet capital. So that means we maintain a balanced portfolio of investments with different risk return profiles to ensure our own sustainability, but also to prove out the model for others to come in. And thanks to this model, we've been able to invest and recycle our capital, providing over £1 billion to social purpose organisations through BSC alone to date, which really sort of demonstrates that sustainability objective in action. I just wanted to quickly give you a sense of the broader market, and I think I've got a graph showing it on the next slide. So alongside that billion that we've invested to date, 2.9 billion has been invested by over 250 other investors, and that's just in our portfolio alone. There's a kind of a broader social investment market in the UK. And so that means that 4 billion has been invested for impact through the funds and intermediaries that we're working with. And that's helped reach over 3,750 charities and social enterprises. And all of those are delivering impact in the UK. The graph here is slightly out of date, but it still illustrates how our focus on sort of mobilising capital has helped improve the match ratios over time. You'll see back in 2012, it was pretty evenly split, but over time we're catalysing more investment from others. So although we're sort of not a blended finance fund ourselves, it really parallels sort of blended finance approaches. But I did want to talk to you a little bit specifically about our blended finance work. And on the next slide, I've got a sort of diagram of a blended finance structure that we've been invested in with our partner organisation, Access, the Foundation for Social Investment. So we recognise that our capital alone doesn't meet the needs of every part of the sector. We are really looking for those market rate returns in most cases. And that excludes lots of organisations, especially organisations operating at the sort of community scale. We know that those community-based charities and social enterprises are often delivering the deepest impact. They're really entrepreneurial, they operate in some really challenging markets and places, and they know their communities really, really well. But they obviously also face really significant challenges with sort of slim margins and fragile revenue streams, and that makes lending and investing with them really, really financially risky, essentially. And so that's why our sister organisation, Access, was set up in 2015 to really help bridge that gap between the needs of charities and social enterprises and investors through grant. They deploy grants into social investment organisations to mitigate those risks, and that blended approach enables us and increasingly others like us to come in. So what are all the arrows on the screen? This is Access's first blended finance programme. It's called the Growth Fund, and it was launched in 2016. And the aim here was really to increase the availability of small-scale social investment to those charities and social enterprises I was just telling you about. All of the investments the Growth Fund made were going to be 150k or below, investing across England with many of the organisations it was working with as first-time borrowers. And it's a tiered structure, as you can see, that brought together grant, so that's all the pink arrows flowing through, and loan from BSC, that's the blue arrows. And the grant here was used in three quite intentional ways. So grant A, as we call it, went to cover the operating costs of the fund managers to enable them to deliver this work because of the sort of challenging economics of investing into this part of the market. Grant B was really that first loss capital, enabling investors like us to participate in addressing the higher risks involved. And then Grant C, which is direct grant going to charities and social enterprises to improve affordability. The programme was delivered by 14 managers across the UK and invested across 17 funds. and that 48.6 million helped make 726 investments into 580 charities, with an average investment size of 67k. So really, really small loans that would have been very challenging to deliver otherwise. And I'm really pleased to say that all capital is now being repaid to PSC, and we're on track to get a return from the programme. So I just wanted to put this out there as a sort of example of a blended finance structure that's helped reach sort of previously underserved markets.
Thank you very much, Julia. So I think this example is for me very illustrative of the complexity, but at the same time, the very intentional structure that is being put behind blended finance. I have to say I'm also incredibly impressed by the strategy that was developed by the UK government to purposefully develop an impact ecosystem. I'm sure many governments, if they are online, please be inspired by the British government, and the combination of these different organizations, Better Society Capital with the Access Foundation, has been incredibly purposeful and really supporting the social sector. And then we see here it's just as much at fund level, at investee level, with a mix of grants and investment. So really happening, you're the typical structure 5, a complex combination of all the different structures. So thank you very much, Julia. We'll maybe have some questions for you later. So moving on to Wouter, if I can move the slides. Wouter, you're a business developer at Triodos Investment Management. Welcome. And you're going to present to us one of the oldest blended finance structures that we know of, the Hivos Triodos Fund.
Yes, thank you, Laure, and congratulations to the NAP on this nice publication to bring blended finance to the attention. And of course to Dolores and Julia for updating on InvestNL and the inspiring example of dormant assets being properly used in the UK. I really would hope we find some dormant funding in the Netherlands also. But we've had funding for blended finance for quite a while at Triodos. Maybe 2 words about Triodos. Triodos is a fully impact-focused bank and investment manager, headquartered in the Netherlands, operating in 5 European countries and across emerging markets. And all we do is for positive impact. Our ambition is to change finance through inspiring other institutions to do so similarly, and also to directly finance change projects. And that's what we're doing also from this Hivos Triodos Fund. So we're talking about blended finance. I don't think the word existed in 1994, but that's when we started to set up this, I would say our breeding ground, our impact breeding ground at Triodos Investment Management, the asset manager. This blended finance fund with Hivos, a Dutch NGO who's deploying initially state money for good causes, with then leverage brought in by Triodos Bank. We started with a focus on microfinance, the early days of microfinance. We believe that can now be funded without any blending, so we've graduated that to other impact funds without blending. And now it's almost a fully direct SME investment fund for emerging markets, focusing on food and energy transition. Last year we celebrated 30 years of this fund. We've deployed about 300 million from this fund. And similarly to Better Society Capital, the ticket sizes are small. And I mean, we're not talking 70,000 here. This is around $1 million per ticket, but for complex international transactions, it's very difficult to do 1 million transactions. And we could not do that without a blended finance structure. Celebrating the 30 years existence, we also decided to grow the fund. So it was about 65 million, and we're now adding development finance institutions to the structure to grow it to around 100 million. And the next slide, we show the funding structure of this fund. So this is your typical blended finance fund, where until recently we had a kind of equity layer. It's structured as a foundation, so I cannot really call it equity, but it has similar characteristics. And subordinated debt, both provided via HIVOS, the NGO that we cooperate with, and then bank loan leverage. We're now growing it to about 100 million by adding development finance institutions, and this is signing of that is today at a conference in Rotterdam. So FMO, the Dutch Development Bank, and the Österreichische Entwicklungsbank, the Austrian Development Bank, are providing leverage. And we also provide an opportunity for retail funders to, in the most senior tranche of this fund, to play a role. So we're growing this fund for small investments. That's the blended side on funding. That's how we catalyze a bit of commercial funding. And that's on the next slide. What I think is the most important part is where you see that little fund at the bottom, the yellow one, where we take most risk and have a lot of direct impact. We take what works from this fund, our breeding ground fund, and bring it to impact funds that do not rely on blending. So for example, microfinance started in this relatively small HIVOS traders fund, but I think we have about 600 to 800 million in financial inclusion funds now without any blending. So there is some capital mobilization happening in the fund, but the real one is happening within what I call the family of funds. We graduate these projects to larger funds, and that's where the real impact, of course, happens. The next slide, I have insisted always to keep focusing on what we do it for. Why do we need blending? I love this example from Sierra Leone. So in challenging countries in Africa, we can provide loans to initially an entrepreneur who exported cocoa, but he decided to diversify into tropical fruits. So instead of supplying only short-term export financing to this entrepreneur, we allowed him to set up a fruit juice processing plant locally, which creates a lot of local employment and diversified his business. And then in financial terms, you move from working capital for a few months to actually a 5 years loan in a country where that would normally not be so easily provided. So in short, in Triodos, we use blended finance for our breeding ground fund, and that allows us to do impact investing that we couldn't do without blending. If things really work, if we can develop a track record, we migrate it to larger funds, which can operate without blending. And very happy to speak to all of you who would be interested to understand this structure more, or provide a form of investment in the junior or senior tranches of these structures.
Thank you very much, Wouter. So again, looking at thank you for reminding us on what we all do it for the impact, of course, the entrepreneur in Sierra Leone. I really like that in your model, you're also using this fund to graduate investees or a whole segment, actually, like microfinance. Once you've proven that it was investable, well, it switches to another more commercial fund, and you're using your catalytic capital for creating new markets. So that's often what's happening with blended finance, and it has a market creation purpose. So maybe let me move on to before we take some questions. I would like to ask the audience maybe you can scan this QR code to fill in a small poll. Can you tell us who from the audience is working on the creation of or with already existing blended finance structures. We're actually quite curious. Thank you. And I see that my team is way more tech savvy than I am. They've already switched to the correct side. So interesting. 2/3, 1/3. 64, 1/3. So how many answers do we have? 15 so far. 46 participants. So can we just click the button? The QR code disappeared. It's let me share again the QR code. You can scan it again. Andrea, can you go back to the Mentimeter so we can see the results? But I think it was 2/3, 1/3, or 60/40. Oh, we got back to 0. All right, technical issue. But I think we were at about, oh yeah, okay, so 2/3, 1/3. Basically, 2/3 of you participants today work with blended finance. So I would like to invite you actually to put in the chat the names of the blended finance structure that you are working on. So let me maybe, once we're finished here, let us go back to not sharing a presentation anymore so we can see our panelists, and ask you maybe the three of you if you could share with the group what do you think is the single most critical lesson from your own case. So it could be in the structuring process, or it could be in the implementation process. What was the most significant lesson? Maybe Dolores, can I start with you again?
Sure. So, as I mentioned, we have a collaboration with the Ministry of Economic Affairs since the spring of 2023, and our first transaction, actually just yesterday, has been finalized, which means it takes quite some time. Although this one we didn't work on for the full 2 years. I think one of the key takeaways is that it does require quite some time to look at these investments and see what is needed. From a governmental perspective, InvestNL's perspective, we need to also ensure that we limit the amount of state aid we put into our transactions. So how can we optimize it while still attracting the private sector? And I think that's a very sometimes difficult dance. And the other thing that might also be worth mentioning, we worked quite some time on solar innovation industries within the Netherlands for blended finance investments, and that's also a difficult market due to other factors, mostly competition from specifically China, and also quite some regulatory uncertainty from Europe, from the European Commission, which then makes it a bit more difficult on what the blended finance transaction is required to do, because you're also still trying to find some more clarity on the rules and regulations. And I think that's one of the other key lessons that I would want to take away, is that if you do create a blended finance structure, you have to really make sure that those elements are clear, and you can speed up the process if you start having that clarity on rules and regulations as well.
Yeah, thank you very much. Aligning on the governance, that was also an important point, an important conclusion of the report. Julia, can I ask you what would you like to add? If you had different lesson learned or some similarities as well?
Yeah, absolutely. I have one of my own, but just to echo what Dolores said, blended finance. Yeah, these things take time, right? It's a team sport. We're aligning lots of different stakeholders behind a single goal, and that's not always easy. Yeah.
Is it? Can I ask if it's related to the public sector specifically, or is it also because you're working in an environment in the financial sector, for example, and that also has sometimes unclarities?
I think it's everyone, right? Different stakeholders come to it with different kind of goals and objectives and restrictions, and understanding and mindsets actually, and understanding where those different parties are coming from, and making sure that everyone gets sort of on the same page can take a bit of time, and then also the sort of structuring and legals is not an insignificant part of the process. Which I guess actually sort of hopefully links to the lesson I wanted to bring out, which is just the value of replicability, and trying to get to the things that are sort of understandable and recognizable for a broad range of stakeholders. So the grant ABC framework is pretty unimaginatively named, but hopefully has helped create a bit of a sort of shared language and understanding in the UK market, that's allowed sort of our partners to clearly articulate what they're doing, what they need the grant for, and other investors to come alongside Access and BSC to provide that grant and investment sort of down the line. And actually we've seen that sort of intentionality about what each of the chunks of grant is doing help to inform how people do it in future structures. So for example, now we have a guarantee scheme that can help provide that first loss capital, and so some funds have used guarantee schemes instead of grant, but are still using the grant to reach particular target groups or to support operational costs for fund managers. So yeah, really being clear about what you're doing and ensuring that that's able to be sort of replicated in future structures, I think, is one of our key lessons.
Thank you very much, Julia. Walter, from your perspective, what was the most critical lesson that you had in the Hivos Triodos case?
I can only echo what Dolores and Julia are saying on it takes a lot of time and energy to understand the objectives of the different stakeholders in these structures. And a government speaks a different language than a financial institution and then an NGO. They have their own stakeholders behind that again. So you need to understand all the stakeholders and the stakeholders behind them to understand what type of reporting they need, what timelines they have, what means success for them. So that makes that blended finance on paper, it seems like a deus ex machina, like a solution that is really easy to deploy. On paper it looks easy, but it's really about taking the time to understand each other's language and ideally make something indeed replicable. So that's difficult, takes a lot of time of senior people often, and so that's also expensive in a way. So my very practical lesson from that, and that's what we did in this Hivos Triodos Fund, is reuse it. Don't see it as a blended finance structure, but as a partnership between different stakeholders. So we set this up as a kind of an open-ended fund or structure, if you want, and then you renew the intentions between the parties involved every 5 or 10 years. But there's a lot of tendencies to do closed-end structures, and then you're structuring for 5 years if you're not careful, and then you have a 10 years operational fund. So in the end, you worked 15 years for 10 years of operation, and that's a waste of time. So I would really argue for partnerships rather than structures, and then within those partnerships, make sure you can adapt to the changes in impact needs, because also Dolores mentioned, solar was challenging, competition concerns and regulation within Europe, but also Chinese imports, etc. But maybe by the time we've solved that, another impact category, like now Avantium, needs to have a push. So if you lock yourself in too much in a structure, it's difficult to adapt. So I propagate partnerships rather than blended finance structures.
Thank you very much. And recycling. We all want to support circularity, including in the financial sector. Recycle your structures. Dolores, there was a specific side question for you in the chat, asking if you could clarify a little bit on the regulatory uncertainty which you faced from the European Commission.
On solar. So we looked at a rooftop solar industry. And for companies within that sector, and actually also just the solar industry within the Netherlands, there were different companies which seeked financing from the National Growth Fund, and they within their business case are quite reliant on the commercial outview for solar demand within the Netherlands and within Europe. So what we saw within that case is that for commercial viability, you needed to have a price that was competitive. Otherwise, it would be for other parties within the market way more interesting to buy rooftop solar panels or other elements related to the solar industry from a different market. And this market specifically, China is the main one providing such components on a highly subsidized, I think, level within the country. So that makes it very difficult to come up with a competitive price for these Dutch companies or European companies. And that's why it was so important for the rules and regulation within Europe. So there's discussion on tariff, and there's also still uncertainty on other rules and regulation elements that could help set that price apart. So you could think of potentially looking into obliging specific offtake to be more green. So you have like a green premium price that could make it more competitive for these Dutch or European companies to set their products in the market. So hopefully that clarifies it a bit more. There are a few research papers that our solar research team has provided on that as well in more detail. So if you want to read a bit more, you can hopefully find that. And if you're not able to find it, please let me know.
Thank you very much, Dolores. And I think this highlights as well one of the challenges of blended finance. Wouter just mentioned, it takes years to build a blended finance structure. And in the meantime, the context is changing. So that's a sort of double challenge. You have to adapt while taking out, and that's why trying to recycle existing structures with parties that already put it in place is actually one of the key lessons learned, that you can be more agile in the structuring. Maybe so again, I want to invite the participants to the webinar. If you have any questions, please put them in the Q&A. I have another question actually for a panelist. What do you think? What was the catalytic element in each of your structures that made the greatest difference in mobilizing capital? So blended finance, we often say it's a leverage. Basically, it's helping bring more mainstream finance to achieve more impact. So what was the greatest catalytic capital element for your organization? And maybe this time I will start with Julia.
Yeah, sure, sounds good. And I guess I think I've got two answers to this question. One, the very obvious one. I think I talked about us looking at this kind of structure as a bridge between the needs of investors and charities, and without that first loss grant, BSC and other investors like us simply wouldn't be able to invest in this part of the market because of the risks involved. So yeah, that's been sort of crucial in mobilizing our capital, but also others alongside us as they've seen how this model works. But I also wanted to touch a little bit on that grant to the fund managers. Like I say, a 67k loan is a pretty small investment. And so you're not earning a huge amount of interest on that. But the amount of work that needs to be done to deliver something like that is still pretty sizable. The due diligence, the portfolio management, but also often working alongside organizations who are accessing investment for the first time, don't necessarily have a sort of business plan in the same way that some traditional businesses would have. And all of that work takes time and needs to be funded. And so without that grant to the fund managers, I really don't think this part of the market would be as sort of vibrant as it is now in the UK.
Thank you. Yeah, again, highlighting the market creation part and the fact that some segments are just not yet economically interesting for more mainstream finance. So you need to subsidize them one way or another, and it can be with grant, it can be with high risk taking from the catalytic capital or return enhancing until it gets to the appropriate level. Maybe Walter, on your side, what would you say was the catalytic element that made the greatest difference?
In case of Vivo's Traders Fund, I think the catalytic element is in proving asset classes that then can graduate or mature to larger commercial funds. So purely quantitatively speaking, the real leverage comes when we transfer these assets to, or not these assets, this asset class to other type of funds. And when you're in early markets and nascent markets, really deep impact, it's a lot of work indeed, as Julia says, and a lot of risk still. And that's where you need the support. And indeed, it's not only in the funding and bringing it to an acceptable risk return on paper, but also there's excessive amount of senior people that need to work on complex small transactions. And that is very difficult. We're a private sector player to do without any support. So although we don't work with TA support to our funds at the moment or to our clients, so we do it in a very lean model, it's very challenging to do this blended finance as a private organization for over 30 years. So we'll keep doing it, and we'll need to make ends meet on the larger funds. That's the reality for us. And luckily, that's also where the largest catalytic impact is. It's very difficult to scale blended finance. Once it works, we rather do it in commercial impact funds. That's much faster and easier to scale than these nice partnerships that we develop for the deep impact breeding ground fund.
Thank you, Walter. Dolores, is it also your experience that actually the leverage is really happening after the blended finance structure? Or do you also feel you also have, because it's not really, it's at investee level that the blending is happening. So do you also see the leverage happening at that level, or do you see more leverage happening actually after in the following rounds?
Okay. Yeah, I think if you also look at the data, the following rounds are typically higher leverage, because you can really lock in more private investors that in the stage of investment where the risks are already a bit lower. I think if I look at the catalytic effect, I think there are two things in the structures we set up so far that are interesting to mention. I think the first one is the question from private investors for clarity on well, actually more certainty. So they want preferably actually a pure subsidy, so they really know how they can take the public investment into consideration for the total financing strategy of a company or project. And I think that's already also leading to quite some discussions, because we are trying to limit the amount of state aid we provide. So I think that's leading right away to some complexity, but it is I think the ultimate catalytic effect is obviously when you take on more risk relative to the private investors. So that is what we see so far, is that subordination. And the other thing that investors are, and then mostly the companies are also really looking at, is not being obliged to, and I think we have that possibility within the structure we set up to repay in those first years. So for the startup and scale-up companies, very important to be able to create some increased production first and get positive numbers before you have to make a return on your public investment. And I think that's one of the key other components that the private investors and really the companies and projects are looking at. Can you help us create financing that doesn't right away make us have to create a return on that? So that's what we've seen so far.
Yeah, the patient capital. So
exactly, yeah. Patient capital. Yeah.
We actually have a follow-up question for Wouter and Dolores from the Dutch side. To what degree do you see interest from institutional investors in the Netherlands for blended finance for the benefit of impact investing? So maybe Dolores, do you want to continue?
Yeah, start on that. Yeah, I don't know if you've read it as well. Our CEO, I think, in the beginning of this year, also mentioned it in the basically the Financial Times of the Netherlands, FD, newspaper, on this possible fund that we are trying to set up with institutional investors, focused on venture capital market. Also trying to focus on the Netherlands here, as you can imagine, for InvestNL. So that's something that's in the works, and looking at the larger pension funds currently to set that fund up. So that's progressing. And ultimately also one of the key things for InvestNL is to look more into how we can create and I think better partnership, as Wouter already mentioned before. You need those partnerships, and I think that's what InvestNL tries to create a bit more in the future as well. It's one of the key strategy points.
Thank you. Wouter, how do you feel about institutional investors? Is there some demand that you feel on your side from Triodos?
Well, we do see institutional investors shifting to impact investment in the Netherlands, luckily, and with very significant volume ambitions. So that's super positive. At Triodos Investment Management, we mainly cater for them through mandates and through our commercial funds, not in blended finance solutions. But I do see possibilities there. If you look at climate fund managers or some other parties, there have been structures where some institutional capital has come in. The example I just presented is not suitable for institutional because of the scale. I would say it depends a bit on your definition of institutional, but I'm really thinking about life insurance or pension funds here. So some types of blended finance are definitely suitable for that, but we would need to keep it really simple, and we make it overly complex often with our blended finance. So in my view, institutional investors understand government risk, zero risk weighting, because there is either several governments or EC or Dutch governments backing that they get, right? Then you're in your sovereign safe bucket. If you create other types of risk sharing layers, etc., the complexity is often not worth the benefit, in my view. So if we go more to the institutional segment, I would really be favoring very simple structures and at scale. So you need large ticket sizes, very clear asset focus, and very simple structures with real de-risking that everybody in the treasury, in the investment offices can easily support there. So yes, we will get there with the amount of volumes that need to be deployed in impact investing in the coming years. I see really good opportunities. But we need to keep it simple and translate it again to the language of that type of investor. It's a new type of stakeholders coming to blended finance, their own internal stakeholders and external, and we'll have to adapt it to that stakeholder, and that will be simple sovereign risk to de-risk.
And maybe a way of involving different stakeholders. The question was about institutional investors. I don't know if we have many foundations on this call, but I think, of course, we see public funding, de-risking, but we can also see foundation philanthropic funding trying to increase the scale of their impact, which was typically what HIVOS aimed to do with the HIVOS Schilders Fund. So I think time is now unfortunately running out. I would like to really thank the three of you, Wouter, Dolores and Julia, for taking the time to prepare and to present these case studies. Again, very, very big thanks to all the providers of case studies in the report. I would like to really invite the audience to scan through them. The team has done a great work of trying to standardize the unstandardizable by trying to use the same format for every case study. If you have some comments, questions, remarks, please do not hesitate to send them to the NAB, to the team. The easiest is contact@nabimpactinvesting.nl. And we hope to be able to continue the conversation with many of you. And thank you again, and have a very nice day.